Welcome again to this show, and tonight we are introducing a new feature on our program. It's called Money Moves, and it's brought to you by 27-4 Investment Managers, and we'll be discussing economic issues as well as how they influence your own personal finances. And the big issues recently, for instance, were the movement of the currency as well as the increase of the interest rate by the Reserve Bank. And of course, there will be other related issues that are raised as we go along. And Nadir Thokan is with me here on the show.
Pleasure to be here, Tim.
And
Pleasure.
welcome. You know, I want to talk about the currency, but I actually like your name because it relates to somehow to money itself. It's a token. It's a token of respect, a token of value.
Well, hopefully it's not. It's a dollar token, not a rand token, or a pound token and not a rand token at the moment, given what our currency is doing.
Well, but you know, give us a chance. You'll see things might reverse and improve.
Well, they have. You know, subsequent to the interest rate decision, we have seen it pull back a little bit. But I'm sure we'll talk a little bit about that.
All right, we'll come back to the currency in a moment. But let's talk about the decision by the MPC of the Reserve Bank, right? There are a whole number of things that they probably considered for them to increase the interest rate by 50 basis points. And I said to someone recently that, can't it just be half a percentage point so that we all are on the same script, right?
Unfortunately, that's not the way it works, Tim. So, let's contextualize this a little bit.
Sure.
So let's take a step back. The Reserve Bank of South Africa has a mandate to target inflation. So inflation has to be within a 3 to 6% band for the South African economy. And the reason they do this is that they encourage or they try to maintain price stability.
Yep.
And in maintaining price stability, they try to attract foreign direct investment into the economy. They try to attract foreign flows into the economy because foreign investors feel a lot more confident investing in an economy when there is price stability. So I think that's the first important thing to mention. And unfortunately, the Reserve Bank has been very, very single-minded about their inflation target, and they have been for some time, whether it's been to the detriment of the South African consumer or not. And, growth doesn't feature within the Reserve Bank's mandate. And as a result of that, we all feel the economy biting exceptionally hard. We're talking about economic growth sub 1%. We're talking about, a global backdrop which is not very supportive. The world is not demanding a lot of South African exports, and that's why commodity prices are under pressure.
Sure.
We're talking about 25% unemployment in the South African economy. Yet, the Reserve Bank's mandate is to target inflation. There has been some talk recently, about addressing that mandate and possibly addressing nominal GDP. But for the time being, the Reserve Bank's mandate is to target inflation within a 3 to 6% band. And bearing that in mind, they can't let factors such as economic growth or unemployment influence their decision too much.
And that's where I suppose a lot of confusion emanates from. And ordinary South Africans think to themselves, why would anybody increase the interest rates in this kind of environment that you've outlined? That actually we need more help than pain from the Reserve Bank.
Well, that's exactly right. But, if we look at what the Rand has done sort of over the last 12 to 18 months, even going back further than that, and if we look at what our current account deficit has done, which is very simply the amount that we import less the amount we export. Our imports have been going drastically up and our exports have been dwindling on the back of, whether it be strikes in our economy, whether it be underinvestment in our manufacturing sector because confidence is not there, whether it's been due to an import in input costs for the stuff that we manufacture, given the extent to which the Rand has weakened. Our exports have drastically underperformed for the last 2 years. And as a result of that, our current account has come under pressure and the Rand has come under pressure as a result of that, which is very inflationary towards our economy.
But is the point to discourage us from borrowing more, or what's the point of this?
So the point of hiking interest rates is essentially, as you mentioned, to discourage the public from taking on more debt, to discourage the public from spending more money or incurring more debt to spend money. And in dampening that demand term, hopefully what will happen is that the inflationary pressures won't be there and inflation will come under control back to within the 3 to 6% band. So the Reserve Bank forecast that it's going to peak outside of that band round about the second or third quarter of this year and moderate to within that band early into 2017. So hopefully because demand is being dampened as a result of increasing borrowing costs.
What does this mean for ordinary South Africans? I mean, okay, in general terms, once you are told interest rates are going up, what should you be thinking about?
Well, the first and foremost, you should be thinking about that my debt is going to become a whole lot more expensive. So any debt which I may have, be it a bond on my house, a car loan, a personal loan that I have through a bank, the Edgar store card where I've used up my 6 months interest-free grace period, whatever debts that you've taken on as an investor, it's going to become a whole lot more expensive to fund that debt. So you've got to fork more out of your monthly budget towards paying down your debts, because interest rates have gone up. So that's first and foremost. Secondly, you should be thinking, well, in this kind of environment where interest rates are going up, I should try as much as I can to not take on more debts. Now, we know that the South African consumer loves to consume. The South African public loves to consume. We know that our savings rate is very, very poor. We're talking about sort of a debt to GDP ratio a debt to GDP on the personal income level, sort of in excess of 60%. So consumers love to borrow money to consume, and they spend a lot of their disposable income is used in consumption as opposed to saving. Now, that mindset has to change. In an increasing interest rate environment, you've got to be saving.
And of course, we may look at this in a negative sense in terms of how it impacts us, but there's also a positive connotation to the move.
Yes, definitely, and that's exactly what I was mentioning just previously, that, you've got to look to save more in this kind of environment. Yeah. And for savers, higher interest rates are definitively a positive thing. Sure. We're talking about, if you have a fixed term deposit at a bank, that's earning you interest, it's now going to pay a whole lot more interest to you. So it's encouraging people to save in those kind of investment vehicles. If you invested in financial markets, money markets investments are now going to yield a whole lot more. We're talking about money market investments yielding somewhere in the region of 6% last year. That's obviously on an increasing trajectory, just with a 50 basis point increase, which we saw from the Reserve Bank Governor on Thursday. We're talking about money market rates going up by at least 50 basis points on an annualized basis. So savers are encouraged to save more because they earn more interest by parking money in money market accounts.
So if you are a consumer, it's bad news. Or if you are consumption-oriented, it's bad news.
Yes.
And if you are savings-oriented, it's a positive thing.
Absolutely, and it's not only translated through higher money market rates or through higher sort of interest you earn at your deposit on the bank. I mean, if we think about how this impacts some sort of company earnings, so if we look at within the context of South African banks, we all know that banks sort of make money. They borrow money from the Reserve Bank at the repo rate, which is 6.75% after the move on Thursday, and they then extend credit to the public where they add a premium over and above their borrowing rate from the Reserve Bank. Prime interest rate at the moment, 10.25%. Depending on your credit rating, you either get prime plus or prime minus. So that spread is where banks make money. And if you own banking stocks, we all know that they've hemorrhaged into December, and the sell-off has continued into January. If you hold banking stocks, higher interest rates are definitively a positive thing because banks' margins are going up. The amounts of profit they make from the loans which they currently have extended to the public, provided they're floating rate loans, which in South Africa, the majority of loans are floating rate loans. Those loans are all of a sudden going to become a whole lot more profitable to the banks because they're going to earn more. The consumer has got to pay a higher interest rate, so more money on a monthly basis to the bank, and that improves their profitability. So long term, it's a positive story for the banking sector.
I want to talk about the currency because we conflate the interest movements with the currency movement sometimes, and they are not necessarily related, I would like to believe, because the currency has been depreciating rapidly recently, and then with the move on the part of the Reserve Bank, I noticed that it somehow pulled back and stabilized around 16 instead of moving forward to 17, 18. Is there a relationship between the two?
Well, there would be a relationship between the exchange rate and the interest rate. So essentially, what drives the exchange rate, it's like everything else in economics, it's demand and supply. So, if demand exceeds supply of a particular currency, the currency would strengthen. And when supply outstrips demand, the currency weakens. So, if South Africa is offering higher interest rates to depositors in South African banks or higher interest rates to investors in our fixed income markets, we attract more capital inflows
see.
into
So
the
there's foreign capital that comes into the financial system as a result of the attractive interest rates.
Exactly right,
Yeah,
Tim.
yeah.
Exactly right. So if we look at what the Federal Reserve did earlier in the week, just before the move by the Monetary Policy Committee, the U.S. Federal Reserve decided to keep interest rates on hold. The Bank of Japan ramped up stimulus within the economy and cut interest rates, in fact, to negative territory. So on a relative basis, the hike of 50 basis points by the South African Reserve Bank resulted in some sort of inflow of capital into the South African economy in search of the higher yield because of the higher interest rates. And we saw an appreciation of the rand. Well, and secretly, that's what the Reserve Bank would have been hoping for, because inflation, to a large extent, is being driven by the weaker currency. So if they can get the currency to stabilize or even strengthen, that sort of puts a dampener on the sort of soaring inflation which we've seen in the economy over the last couple of
All
months.
right, money is moving, right? As we say, money moves on this segment of our program. Now, summarize all this for me. Depreciating currency, then it's strengthening, interest rates are going up. I'm an ordinary South African. Just tell me shorthand, what should I think about this?
Well, I mean, shorthand, I think you should first of all be thinking, pay off my debt as quickly as possible, because it's becoming a whole lot more costly for me to pay off my debt. Number two, take out as little new debt as possible, because it's expensive to do that. And number three, save as much as possible, because it's becoming a whole lot more attractive for me to save. Depending on your risk and return profile, if you're a very low risk investor, money market and bank deposits are paying a whole lot more. If you slightly higher up the risk spectrum and have a longer term investment horizon, our equity market has sold off quite a lot in the last 2 months. It's certainly a more attractive entry point than it was 2 months ago. And the banking shares particularly come to mind, given that they're going to reap extra profits from higher interest rates. And they've sold off probably the worst, apart from a couple of the resource stocks, amongst the worst performing shares over the last couple of weeks have been the banking stocks. So save as much as possible and pay off your debt as quickly as possible, and take out as little debt as possible.
There you go. And that's the advice from Nadir Thokan. And thanks very much, our expert, helping us make sense of all these terms. Movement, interest rates, depreciating currencies. Sometimes it can be very confusing. But of course, he summarized it for us. This is the Money Moves on Tonight with Tim Modise.